Surf's Up. Learn to ride the F&O waves only on Bloomberg Quint with Agam Vakil.
Hello and welcome to Surf's Up with me, Agam Vakil, on Bloomberg Quint. And as usual, we're here to get perspective and ideas on the futures and options space in Indian equities. The Indian markets have made some progress, leaving behind an extremely volatile November expiry. The Nifty is back above 8200. FIIs continue to sell in cash markets, but the good news is that they are buying index futures with more bets placed on index calls than puts. But remember, we have a few events lined up which could induce volatility, which has fallen substantially since last week. The most important one being the RBI policy this Wednesday, and to a much lesser extent, the Italian referendum. So are the markets headed upwards? Let's find out. Joining us today and helping us simplify some of this data and unearth trends is Mr. K. Subramanyam, co-head of equity advisory at Altamount Capital. Hi, Mr. Subramanyam. Very nice to have you with us today. And with that, I'd like to ask you, where is the Nifty headed for this week?
Well, broadly, I think we have seen a stellar run, and probably that is on the back of a lot of pessimistic shorts which were created at the beginning of the series, and subsequently, we have seen some good call unwinding, and also we have seen the markets holding up levels of 8200. What might possibly happen is today, of course, we might see some pause. We also have a bank expiry, so we will probably see some sort of profiting coming about, and also we have had the crude surging yesterday. So probably 8150 should be the bottom for the day, if at all we skip today. But broadly, I think we should see some sort of support emerging at the lower end, and particularly considering the fact that Bank Nifty, which was showing signs of weakness, has again revived.
Okay, so you did mention that 8150 can be the bottom for today, but with respect to levels on the Nifty for the next 3-4 sessions, what are you keeping in mind?
I think going by the put writing that we saw in 8000 as well as 8100, probably 8100 should be the floor for the time being, and on the upside, I think 8400 could well be on cards in the coming days. Okay,
and with respect to the Nifty Bank, how are you viewing the movements here?
Bank Nifty saw some pretty decent recovery yesterday. I think 18,600 thereabouts. Today, again, bit soft. But I think it's approaching to a very critical level from where it actually broke down, I think, sometime last week. So 18,800, if you could close above 18,800, I think that will be a very good sign. And probably that's the space where I think which will lend some support to the market. So going by the fact that we also have credit policy coming up, and the expectations are high, so probably we will have the Bank Nifty maybe going up to levels of maybe 19,000. So probably that's the place to be in for the coming week.
Okay, so that's as far as big indices are concerned. Any calls that you have on stock futures or stock options?
I think going by the trend today, probably one could bet on some of the oil and gas majors which have seen some pretty decent action. So Quint India would be my top pick. That's quoting at around 255. So I think that could surge and move past its previous high. Maybe levels of 270 could be expected. The second one, of course, again going by the action in the derivative segment, something like an Engineers India, which has seen some pretty decent gains in the last few days, and also managed to cross 300 today. Probably levels of 325, 330 could be expected. And the last one is something, Gas Authority of India, which seen some decent correction, but closer to levels of 415, 420, I think offers a decent bet. We could see levels of 440 in the coming days.
Right, then coming down to Derivatives 101, and once again I want to remind your audiences that we are open and inviting questions for our guests. The question for this week comes from Naman Shah, and Mr. Subramanyam, he asks, what is a bull call spread and when do you employ it?
Well, bull call spread, ideally it's some sort of a hedge, and so it's wherever the position trader wants to sort of cushion any volatility, a bull call spread is taken. For example, if I were to buy an 8,000 strike call and sell an 8,300 strike call, that's ideally called a bull spread. What happens is that the profits are capped, but the premium that I pay for the 8,000 call is partly cushioned by the 8,300 strike call which I sell. So in the intermediate term, if there is any volatility, what happens is that if the market also becomes a bit range bound, the 8,300 strike call which I have sold, that sort of cools off and sort of compensates for some downfall which could possibly happen in the 8,000 strike. So it's basically a hedge against with a bullish bias, which is always better rather than take a naked call of say buying an 8,000 strike call.
Well, I hope that answers your question, Naman, but that is all that we have today for Surf's Up. Thank you, Mr. Subramanyam, for joining us and simplifying some of that data for our audiences. As for you listeners, do come back next week and join me for yet another edition of Surf's Up, only on Bloomberg Quint.